Welcome to TheoTrade and the weekend update. This is Don Kaufman here on August 19th, 2017. Let us begin here on this weekend update by recapping what we're now terming. Well, you wanted volatility, you got some volatility. Markets seeing again a fairly wild Thursday. I say a fairly wild Thursday because that's the last two Thursdays in a row have seen some fairly extreme volatility. However, even yesterday, which was of course Friday's trade, we ended on Friday down about 4.5 points in the S&P futures. Nevertheless, they were rather volatile out there, rallying and selling off. Okay, to kind of begin with, so we're seeing some volatility, but let's, during this weekend update here, kind of try to answer the question, are we in the middle of a much larger move? Okay, are we going to see volatility start to really rupture and start to explode? And I'm going to cut to the chase right now, and I'm going to tell you, we're going to look at a number of products here momentarily, and I think you're going to be a little bit intimidated, and you should recognize right up front here that it's not just a tremendous amount of risk, it's how the volatility is describing this risk as nothing less than extreme, and yet we haven't truly seen any extreme moves just yet. So volatility right now is, and I know a lot of people look at the volatility index, that's not what I'm going to reference over here, but the volatility products that we look at happen to be exploding into highs, and that's much more prototypical of 5, 6, 7% moves inside of the S&P 500 of the likes we've seen nothing like a 5, 6, or even 7% move. So let's get kind of right to work over here. Let's start in the SPX, and in the SPX, I'm going to bring up what we term our expected moves. Now, last week, all throughout the course of the week, I kept warning you, listen, we had a massive expected move. So last week, the expected moves as depicted by the options, we were expecting over a 40-point move, and that's a 40-point move higher or lower. Again, higher or lower. Did we move the full 40 points? Well, no, this is ultimately where the week started. The week started right at about 2440. We exploded up to the 2470. So we saw over approximately at the absolute peak over here, we saw about a 35-point move to the upside. And then, of course, markets just ruptured a bit lower, but we're well inside of the expectations of risk. Now, we're going to move right forward here. The SPX for this coming week. Now, when I say this coming week, yes, I'm projecting forward. We're starting, the week here of August 21st. What are we looking at? Well, we're going to go take a look specifically at the option chain. If you look out over the 6-day period, we're expecting almost a 34-point move higher or lower. So is the risk as phenomenal as the previous week? Absolutely not. This is over a 40-point move. Here we're sitting right around, again, the middle of the $30 moves. Now, a $30 move, you should recognize based on where we're currently at. So the week ultimately closed, and I'm going to highlight this right now. Inside of the SPX, the week closed at 24.25. Okay, right there, 24.25. So what again are we looking at? This is depicting about a 34-point move higher or a 34-point move lower. That would actually take us very, very close to 23.90 if we did head lower, okay? We saw some heavy sell-side activity on Friday, and this is part of the alarming part. So again, 34-point move. Let's move over to the futures, and let's take a quick glance at the futures. This is a 30-day, 1 hour. I'll explain the levels here in just a moment, okay? The alarming part is we saw sell-side activity on Thursday, and that's what I'm actually dragging my mouse over currently. The market ultimately tried valiant effort at a bounce and was sold into, and sold quite heavily into as the day kind of progressed over here. For those of you watching the marketplace yesterday, and I'll actually tune into yesterday's trade, as I said, we sold off a little bit at the open. We exploded higher. You know where we exploded higher to? 24.38, pretty much on the button. That was one of the price levels that we talked about earlier in the week. We talked about it the previous week. 24.38 inside of the S&Ps, okay, is an absolute key marker. It's a threshold. You need to keep it in mind. okay, we hit it. Volume absolutely exploded to 15,000 contracts a minute. And then we came in pretty hard and fast off of that. And I have to tell you, coming into the close over here, it just felt like a bottomless pit that last 15 minutes. Things mellowed out in the 15, 20 minutes after the close. We rode off into the sunset on a Friday afternoon. Nevertheless, things got a little bit tense after hitting that 24.38. Now, if I zoom out again for just a moment here, there's two levels on the screen. Again, top 24.38, on the bottom here 24.11. Now, 24.11, hitting that over here could be rather catastrophic. 24.11 is kind of the final straw, the last hope out there. You can see we actually did hit that, all right, back earlier in July, and it was the absolute reactionary low over there. Again, at some point throughout the course of this next week, I absolutely believe we're not only going to hit 24.11, I think we're actually going to cross through 24.11, and we're going to see a little bit of fireworks. What am I basing that on? Okay, so this is the point in time where let's move a little bit away from levels, let's move a little bit away from expected move, and let's start talking about a couple of individual products out there. And I want to show you, the bigger question is a correction of some type already underway? And to answer that, so I could look at a number of different stocks and so forth, but before I get to the individual products, I want to look at the volatility of the volatility index. And as you guys know, I talk extensively about volatility, okay? Because what the volatility is displaying, and this is the VVIX, okay? I don't use the VIX. The VIX is like my predecessors, whatever. The VIX is a dead idea, because the VIX is displaying the option activity specific to the SPX, okay? So what I'm saying is the VIX only starts to move when traders start coming in and trading the options in the SPX. But in today's marketplace, they don't really do that anymore. That was 10, 15, 20 years ago. In today's marketplace, they actually trade the VIX options themselves. And the VIX options themselves, because they're a much more volatile product, the VIX options themselves give professional traders more bang for their buck. So they prefer to trade the VIX options themselves. And those VIX options themselves, their VIX, it's the VIX of the VIX. You got to love this stuff, right? The VIX of the VIX is the VVIX. And the VVIX is just displaying like insanity over here. This was last Thursday, it's spiking up, came back off. It is very rare to see the VVIX come back up. We're over the 110 threshold. And again, if you haven't seen this in earlier videos, I want to show you where we are over the last 3 years. The only time that volatility has really been in this serious of a situation, you got to start looking back. Okay, so there was the election, there was Brexit. By the way, the election, definitely took the volatility up a little bit. We had Brexit. And you start going back in time, this huge spike over here, that was August of 2015, which was, remind you, that was a 7% move down in markets. So the volatility of the volatility index, okay, is for the most part, all right, at this point, as serious as it gets. It doesn't mean, okay, that the markets are going to tank and that tankage is imminent. I want to make that abundantly clear. Just looking at the VVIX, that means the markets are going to tank. No, it doesn't. But it does mean, okay, that the professional world is taking, okay, the current market and they're pricing it as risky as they have any of the other major events that have unfolded. And again, we're showing a little bit about Brexit and again, the election over here. If you're curious about like the election versus right now, so here's what the VVIX was doing pre-election, okay? It actually eclipsed that. It's showing the risk, okay, in the past couple of days is being higher than the election. You got to shake your head at that one, right? It is. That's the way to look at it. You look at something like Brexit that was back here in May. It's showing the risk actually got a little bit higher right now than it did over Brexit, Okay? Again, the only time this thing has really been higher is back here. When I say back here, I'm going to zoom all the way in. Back here, when the VVIX got all the way up to like 135, this is actually in December, okay? December of 2014, okay? We start cruising forward in time. And you'll see the VVIX also take back off. Again, you go into 2015. These were major volatility type events. In fact, if you take a look right here at the VVIX spiking up, again, this is now December of 2015. This is prior to the S&P 500 coming down heavily. The S&P 500 touched all the way down at the same exact time frame to 1800. Okay, in fact, we'll just take a look at the S&Ps, the exact same time frame. This is when the VVIX was ultimately spiking, and this is what happened to the S&Ps after it. Okay, this is the VVIX spiking, was right in this neighborhood here. The market came down. Again, every time the VVIX is spiking, you've seen some fairly phenomenal volatility events. Doesn't mean that a volatility event is going to unfold, but I will tell you, you better respect it because the conditions are right. Now, in addition to just looking at, hey, Captain Obvious, right? The VVIX is all lit up. I got it. I want to start looking at products like the XLF. The XLF really bothers me at this point. The XLF has been really tearing to the upside. By the way, this is a year to date. The XLF year to date is only up now about 4.72%. Okay, that's the XLF. Compared to the spiders, just compared to the spiders are still up 7.7%. What's holding the spiders up when the financials are falling? Oh, there's an easy answer for that. It's called the Qs. Okay, here's expected moves in the Qs. The Qs are still up 18%. But make that relative to the IWM. You can look at the IWM, you could look at the Russell, whatever does it for you. The Russell is actually now down on the year. So you have to recognize, okay, the tale of two different worlds that we're seeing over here when it comes to index products. The Russell is already in the midst, okay, of corrective territory. Here's the Russell year to date up 6%. Now it's down about 0.4%. You're just shy of starting to get into what they really start to call corrective territory. The XLF is kind of taking it on the chin. Do I need to get into retail? Okay, if you want to start looking at retailers here, you can start with an ETF like what? Here's the XRT. This is the retail ETF. Year to date is down 13.79% year to date. Go look at some of the retail stocks over there. Nobody wants to touch them. By the way, speaking of which, this right here, I actually view as an opportunity. So you have a number of major areas that are starting to hit corrective territory. Why aren't you hearing more about this? Like, why isn't it on the forefront? It's because everybody's still looking at Facebook. Okay? They're looking at products like Apple. What we have to recognize, okay, in this situation is the bifurcation that we're seeing. Let me explain what this bifurcation happens to be. The bifurcation is stocks like Apple that are up here in Never Never Land, and ultimately retail that's down here, bottom fishing at this point. I mean, it's literally laying in the bottom of the pool dead. The bifurcation is going to close. That bifurcation is going to close. I believe the bifurcation is going to close, and it's going to be violent, and it's going to be your Apples, your Googles, your Amazons, okay, your Microsofts, your Facebooks that are going to come off hard and fast. And that is ultimately what's causing the performance in the S&P to still be decent. You have sectors in the S&P right now that are hideous, okay? Again, some old school buddies of mine, the old school traders, they have tendency to still look at Dow Jones like the transports. And I talked about the transports a bit earlier this week as well. The transports are unchanged on the year. But that's not the point that I want to make. This is a year-to-date percentage. The point to be made is the transports were up almost 8%. Now we're flat. Again, we're in like almost full-blown corrective territory on the transports. Okay? Yet, you start looking at stocks, and I mentioned FedEx earlier in the week that I think FedEx is going to break down. It did. It sold off a bit over here. But this thing hasn't even gotten started. Okay? You got to look at stocks like this over the last, again, 3 years, and you're just like, wow, what did they reinvent shipping a box over here? And everywhere you look in this marketplace, you can see this gigantic bifurcation exists. What do you mean by bifurcation? Okay, this is one that Jeff Bierman continually brings up, Bed Bath & Beyond. Why am I bringing up Bed Bath & Beyond? Check this out on a year-to-date. Year-to-date is actually down 33%. Okay? You start looking at stocks like Best Buy. And I know everybody's like, it's Amazon, it's Amazon. Okay, well, no. How come Amazon is not, it's not destroying Best Buy? I just wanted to make a point. It's not necessarily Amazon. But it's, again, you start looking at other retailers like the Macy's, and that's when people point out Amazon. But there are decent performing. However, I'm telling you, retail is taking a hit. But that's not just retail. It's anything to do, okay? You're trying to move a car out there? Great. Ford, that's year to date. It's down 16%. And we can go on and on and on and on, okay? Other retailers, though, we'll look at something like Home Depot. Okay, it's still up almost 10% year to date. And if you take a look at the 3-year on there, I want you to think about Home Depot as a possibility for a stock to come. That's a long way down. That's a stock over the last 3 years, okay, that's still up 54%. And it's just now looks like it's starting to break down. Again, everywhere we start to look, we're seeing signs of weakness in the market. We're seeing volatility elevated. I'm not going to sit here and start to, get on the soapbox and tell you like, get in the bunker. I don't like where the volatility product is, okay? I am looking at the financials. The financials really scare me because at this point, they're losing support. One of the reasons for Thursday's sell-off that's being contemplated, whether you guys know this or not, is an individual, it's political, it's an individual, one individual that currently belongs to the administration that was the second man in charge at Goldman Sachs, okay? And it looks like he may be out of the administration. Do you realize that we're talking, think about the insanity of this. One guy, don't even need to mention his name because it doesn't matter. I don't want to get into the politics and I don't care. But if one guy leaving the administration starts to cause sell-side activity into the entire financial sector, I think you really have to reassess how risky this marketplace happens to be. Again, we're moving into a week. We have over a $30 expected move in the SPX. Respect the expected move. If you don't, okay, it's going to disrespect your positions. Recognize that in a situation where the volatility is elevated and we're seeing some stocks in corrective territory, okay, that is a brutal warning to you. Risk right now is to the downside. Last but definitely not least, remember the levels, okay? If we start to crack under 2411, things get serious in a hurry. At that point, there's no reason that every trading firm out there won't start to sell into this. These are key thresholds inside, okay, of this box. Inside the box of 2438 to 2411, that's the happy place. Start to crack outside of it to the downside, people are going to sell hard and fast into it. Think about it throughout the course of this coming week. Thanks everybody for joining us at TheoTrade. Have a wonderful weekend. Bye-bye.